You've been working with a financial advisor for 10 years? You pay them 1% of your assets annually. That's $7,000 a year on a $700,000 portfolio. They send quarterly reports. They rebalance your holdings. They answer your calls. You think you're getting value. Let me tell you the lie they're all telling. They say they're working for you. They're not. They can't be. The structure of their compensation makes it mathematically impossible for them to put your interests first. And this lie, this fundamental conflict of interest baked into the entire financial services industry, is costing you hundreds of thousands of dollars over your lifetime. Here's what nobody explains. Your advisor makes more money when you do certain things, and less money when you do other things. And the things that make them more money often make you less money, not because they're bad people, because the system is designed this way. And until you understand how the system actually works, you'll keep paying for advice that serves their interests more than yours. I spent decades watching this play out. Watched people with $500,000, $800,000, $1.2 million get slowly bled by fees they didn't understand, conflicts they never saw, and advice that benefited the advisor more than the client. The tragedy is that most people never realize what happened until it's too late, until they're 75, wondering why they don't have more after 30 years of professional management. Before we get into this, do me a favor. Drop a comment right now and tell me where you're watching from. I want to know who's here. City, state, country. Just let me know. This is where people with $500,000 to $1 million saved make their most expensive mistake. They think hiring a financial advisor means hiring someone whose interests align with theirs. They think paying 1% annually means getting objective advice. They think their advisor is on their team. They're wrong. And this misunderstanding costs them between $200,000 and $600,000 over a 20-30-year retirement. Not because of market losses, because of the structural conflicts built into how advisors get paid. Here's what's really happening. Most financial advisors are compensated in ways that create direct conflicts with your best interests. They make more money when you trade more. They make more money when you hold certain investments over others. They make more money when you keep larger balances with them. And critically, they make nothing when you do the things that often benefit you most, like paying off debt, buying more insurance, or holding simple index funds. The people who build lasting wealth in retirement understand that financial advice is a product, not a service. The people who struggle don't see that distinction, and the difference between these two groups isn't intelligence or sophistication. It's understanding how advisors actually make money and who really benefits from the advice being given. Let me show you how this works with a scenario you'll recognize. You're 58 with $650,000 saved between 401ks and IRAs. You're thinking about retirement in 7 years. You meet with an advisor who seems knowledgeable, friendly, trustworthy. They show you projections, talk about their process, emphasize their fiduciary duty. Then they drop the fee structure, 1% of assets under management on $650,000. That's $6,500 per year. They explain this covers comprehensive wealth management, regular meetings, 24/7 access, financial planning. Seems reasonable compared to the value of your life savings. What they don't tell you, what they'll never volunteer, is what that really means over your retirement timeline. Let me show you the math that should terrify you, the 1% fee that costs. You're $380,000, you're 55 years old with $600,000 saved. You hire an advisor who charges 1% of assets under management annually. That's $6,000 the first year. Seems reasonable for managing your life savings. Here's what actually happens over the next 25 years. Year 1, you pay $6,000. Portfolio, $600,000. Year 5, you've contributed more, markets grew, portfolio is $750,000. You pay $7,500. Year 10, portfolio hits $900,000. You pay $9,000. Year 15, you're 70, retired for 5 years. Portfolio is $850,000. Withdrawing now, you pay $8,500. Year 20, age 75, portfolio is $780,000. You pay $7,800. Year 25, age 80, portfolio is $720,000. You pay $7,200. Total fees paid over 25 years, approximately $195,000 in nominal terms. But here's what kills you. That's $195,000 that never got to compound for you. If that money had stayed invested at 7% annual returns, it would have grown to about $380,000. So the true cost of that 1% fee isn't $195,000. It's $380,000 in wealth you'll never have. You gave away $380,000 to someone who probably just put you in a target date fund you could have bought yourself for 0.15% annual expense ratio. But maybe they provided value worth $380,000. Maybe they saved you from mistakes, optimized your taxes, gave you peace of mind. Let me show you what they actually did. Most 1% advisors do 4 things. Put you in a target date fund or basic 60-40 allocation rebalance quarterly or annually. Send you reports you don't read. Take your calls when you panic during downturns. That's it. Nothing magic. Nothing you couldn't do yourself with a Vanguard account and 2 hours of education. Certainly nothing worth $380,000 over 25 years. Here's where it gets worse. That 1% fee is charged regardless of performance. Market up 20%, they get paid. Market down 20%, they get paid. Brilliant work, mediocre work, they get paid exactly the same. Their incentive isn't to maximize your returns. Their incentive is to maximize your account balance, because that's what their fee is based on. So they'll push you to keep more money with them, invest inheritances with them, roll over old 401ks to them. Not necessarily because it's best for you, but because every dollar you have with them generates fees. Let me give you another angle. Nobody talks about the perverse incentive around risk. Your advisor's fee is based on your account balance, not your returns. So they want your balance as high as possible, but they also don't want you to leave. This creates a mushy, moderate allocation designed to maximize fee generation, not maximize your outcomes. You're 55 with 15 years until retirement. You should probably be more aggressive than 60-40. But aggressive means volatile. Volatile means you might panic and fire them, so they keep you moderate to protect their fee stream. This is the first lie, that 1% is reasonable compensation for basic portfolio management with no accountability to actual results. Now let me show you how the conflicts get deeper. Now, I need to pause here because some of you are thinking, but Charlie, my advisor does more than just put me in funds. They do tax planning, estate planning, comprehensive financial planning. That's worth $380,000, right? Let me show you why that thinking is exactly what they're counting on. Here's what comprehensive financial planning usually means in practice. Tax planning. They tell you to max your 401k and use a Roth conversion ladder. That's not sophisticated tax planning. That's standard advice you can get from a $30 book or a 2-hour consultation with a fee-only planner. Real tax planning, the kind that saves you tens of thousands, requires a specialized tax CPA, not a portfolio manager who took a weekend course on tax basics. Estate planning. They tell you to set up a will, maybe a revocable living trust, beneficiary designations. Then they refer you to an estate attorney who charges $2,000, $5,000 to actually draft the documents. Your advisor didn't do estate planning. They made a referral. You could have Googled estate attorney near me and gotten the same result without paying $380,000 over 25 years for the privilege of that referral. Financial planning. They run a Monte Carlo simulation showing you have an 85% probability of success based on your savings rate and withdrawal strategy. This takes 30 minutes with software that costs $50 a month. Is that worth $7,000 per year for 25 years? Here's what kills me. All of this comprehensive planning can be purchased separately for a fraction of the cost. Fee-only financial planner. $2,000, $4,000 one time for a comprehensive plan, $500, $1,000 annually for updates. Estate attorney. $2,000, $5,000 one time. Tax. CPA. $500, $2,000 annually if you have complex returns. Total over 25 years, $30,000, $60,000 for actual expertise in each domain. Compare that to $380,000 for comprehensive wealth management, where one generalist advisor tries to be adequate at everything instead of expert at anything. But your advisor will never present it this way. They'll bundle everything together, make it seem like an inseparable package, and charge you for the portfolio management, which you don't need, to subsidize the planning, which you could buy cheaper elsewhere. This is the unbundling truth they don't want you to discover. Every service they provide can be purchased separately for less, often from more qualified specialists. The only reason to bundle is convenience, and you're paying $380,000 for that convenience. So when you're asking, is my advisor worth it? Don't ask if they provide value. Ask if they provide $380,000 more value than the alternatives, because that's the real cost of your decision. Here's what your 1% advisor will never tell you. They often receive additional compensation for putting you in certain investments. Not all advisors, not all investments, but it's common enough that you need to understand how it works. Mutual funds with 12b-1 fees. Some funds pay advisors 0.25 become 1% annually for keeping your money there. Your advisor gets paid by the fund company on top of what you pay them directly. You're paying twice. Once in your 1% advisory fee, once hidden in the fund's expense ratio. Commission products, annuities, certain insurance products, actively managed funds, these often pay advisors 3 to 11% upfront commissions. When your advisor suggests moving $100,000 into an annuity, they might receive $5,000, $7,000 immediately. Think that influences their recommendation? Proprietary products. Some advisory firms have their own mutual funds. Advisors get bonuses for placing clients in proprietary products. So, you think you're getting objective advice, but your advisor gets paid extra to recommend their firm's products. Real example, client has $400,000 in a 401k from previous employer. Advisor recommends rolling it into an IRA they manage. Option A. Leave it in 401k, client pays 0.15% in fund fees, advisor makes $0. Option B. Roll to IRA, client pays 1% advisor fee, $4,000 a year. Client pays 0.5, 1% fund fees. Around $2,000, $4,000 a year advisor makes $4,000 a year plus potential commissions. Which do you think they recommend? They'll have good explanations, more investment options, better service, tax planning. All might be true, but the real reason is the $4,000 annual fee. Here's another common scenario. You inherit $200,000 from a parent. It's in a taxable account, invested in low-cost index funds. Your advisor suggests consolidating everything for better oversight. What really happens? They move that $200,000 into their management, generating $2,000 a year in fees. They might put you in actively managed funds, paying them 12B by 1 fees, another $500, $2,000 a year. They just added $20,500, $4,000 in annual fees to money costing you maybe $100 a year before. Over 20 years, that unnecessary consolidation costs you $50,000, $80,000 in additional fees. Let me show you exactly how this plays out with someone I knew personally. Real scenario, real numbers, real outcome. Man retires at 63 with $750,000. Works with advisor he's had for 5 years, pays 1% management fee. Advisor is friendly, responsive, sends nice reports. Client trusts him completely. Year 1, age 3. Advisor recommends rolling old 401k. $300,000 into IRA he manages. Says it's for better investment options and coordinated planning. Client agrees. Advisor's annual fee jumps from $4,500 to $7,500. Advisor just gave himself a $3,000 raise. Year 2, age 64. Advisor suggests moving $150,000 into variable annuity with income rider for guaranteed retirement income. Sounds smart. Client agrees. Advisor receives $9,000 upfront commission, 6% of $150,000. Doesn't disclose this. Annuity has 2.5% annual fees the client doesn't fully understand. That's another $3,250 a year in ongoing costs. Year 3, age 65. Advisor recommends moving bonds into higher-yielding preferred shares and dividend stocks. This increases risk in trading activity but generates more fees. Client's account churns more, taxes go up due to higher turnover, but it looks like active management. Year 4, age 66. Market drops 15%. Client panics, calls advisor daily. Advisor talks him off ledge, prevents panic selling. Client is grateful. This is the value advisor provides. Except the portfolio was too aggressive for his risk tolerance in the first place. Advisor created the problem he's now solving. Year 5, age talks to Ivan. Client looks at 5-year results. Started with $750,000. Market was up about 35% over 5 years. His account is at $890,000. Seems okay? But here's what actually happened. If he'd put everything in simple index funds, 60% stock, 40% bonds, and done nothing, he'd have $985,000 after the same market returns. The difference, $95,000 in 5 years. Lost to fees, commissions, tax inefficiency, and unnecessary annuity costs. Over his remaining 20-year retirement, this compounds. At age 87, the difference is $340,000 less than he should have had. But he'll never know. He'll think markets just didn't perform as well as expected. He'll never realize his advisor cost him $340,000. And here's the cruelest part. The advisor will retire comfortably on fees extracted from this client and hundreds like him. The client will cut expenses in his 80s, skip trips to see grandkids, stress about money, never understanding that his trusted advisor slowly bled him for 25 years. This is how it actually works. Not dramatic fraud, not obvious theft, just structural conflicts, hidden costs, and compounded fees that quietly transfer hundreds of thousands from clients to advisors over decades. And it's completely legal. The advisor did nothing prosecutable. He followed all regulations. He could claim he acted in the client's best interest, but the client still lost $340,000 to someone who claimed to be on his team. That's the system working exactly as designed. The money wasn't broken. It didn't need fixing, but fixing it generated fees. This is the second lie, that their recommendations are based purely on what's best for you, when their compensation creates obvious conflicts. But here's where it gets really ugly, where advisors make the most money off retirees. The retirement income trap. This is where advisors extract maximum fees and clients understand the least. The retirement income conversation is where complexity becomes a weapon. You're 65, with $800,000 saved. You need $48,000 annually plus Social Security. Your advisor has a solution: retirement income planning using annuities, dividend-focused funds, and bond ladders. Sounds sophisticated, and it generates massive fees. The annuity portion: put $250,000 into a variable annuity with income rider. Generates 1,000 month guaranteed income. Great. Except advisor gets 5 to 7% upfront commission, $12,500, $17,500. Annuity has 2 to 3% annual fees, $5,000 to $7,500 year fees continue for life. The $250,000 isn't growing, it's stagnant. If you die early, much of that money is gone. The managed portfolio, remaining $550,000 stays in managed accounts. 1% advisory fee. Some $5,500 year fund fees, 0.5, 1% at $2,750, $5,500 year, total, 8 out of 250, $11,000 year. Added up, you're paying $13,000, $18,000 annually on your $800,000 portfolio. That's 1.62% per year. This is sold as retirement income planning, when it's really maximized fees from retirees who won't notice. Here's what kills me. You could accomplish the same thing with $100,000 in Treasury bonds, virtually zero fees, $700,000 in low-cost index funds, 0.05% fees, $350 a year, simple 4% withdrawal strategy. Total annual fees, $400 instead of $15,000. That's $1,400 to $600 a year saved. Over 20 years, that's $292,000 saved. Because that money stays invested and grows, the real difference exceeds $500,000 in lifetime wealth. But your advisor won't suggest this approach. Can't suggest it because they'd make $350 a year instead of $15,000 a year. They have mortgages, kids in college. They can't afford to give you low-cost advice even if they wanted to. Let me show you another retirement scam: the income-focused portfolio. Your advisor builds a portfolio of dividend stocks, REITs, MLPs, preferred shares, all income generating. Sounds smart for a retiree needing income, right? Wrong. Income portfolios typically underperform balanced portfolios over time because they sacrifice growth for yield. Many income investments are tax inefficient, generating ordinary income taxed at your marginal rate instead of qualified dividends or long-term capital gains at lower rates. But income portfolios generate more trading activity, rebalancing between different asset types. Justify active management fees, we're hunting for yield, and create the appearance of sophistication. Your advisor builds a 15-position income portfolio when a simple 3-fund portfolio would work better and cost less. Why? Because they can't justify 1% fees for putting you in 3 index funds. But they can justify fees for actively managing a sophisticated income-generating strategy. It's activity theater dressed up as value add. This is the third lie, that complex retirement income strategies are necessary when they're really just fee generation mechanisms dressed up as sophisticated planning. Here's the lie that makes me angriest: advisors who claim to be fiduciaries but act in their own interests anyway. A fiduciary is legally required to put your interests first. Sounds great, except the definition has been watered down so much it's nearly meaningless. Fiduciary only at point of advice. Some advisors are fiduciaries when giving advice, but not when selling products. They give you fiduciary advice: buy bonds, then sell you high-commission bonds as a salesperson. Same person, different hat, different legal standard. Fiduciary to firm first. Some advisors are fiduciaries to you, but employees of firms with their own interests. Guess whose interests win when they conflict? The firm that signs their paychecks. Fiduciary with caveats. We're fiduciaries except when working with our affiliated insurance company broker-dealer. So they're fiduciaries most of the time, except when selling products generating highest fees. Convenient. Real example. Client age 62 with $700,000 wants to retire. Advisor is an RIA, supposedly fiduciary standard. Here's what happens. What a true fiduciary would say, you have enough. Buy low-cost index funds, 60% total stock, 30% bonds, 10% international. Live on 3.5% withdrawals plus Social Security. Cost, $350 a year in fund fees. I'll charge $150 hour for planning, maybe $1,500 total to set up. Check in annually for $300. What the fiduciary actually says, you need comprehensive retirement planning, managed accounts with customized income strategy, dividend stocks, carefully selected bonds, maybe an annuity for guaranteed income floor, quarterly reviews, ongoing adjustments. My fee is 1.25% annually, $8,150 a year for full-service wealth management and peace of mind. Same fiduciary standard, same client, 5 times the fees. The advisor makes $1,800 total in Scenario 1 versus $8,000 per first year indefinitely in Scenario 2. Over 20 years, $36,000 total versus $175,000. The advisor is leaving $139,000 on the table if they give you the low-cost advice. So they don't. Both approaches are technically compliant with fiduciary standards. I know what some of you are feeling right now. You've been working with your advisor for 10 years, maybe 15. You like them. They've been responsive, helpful, friendly. You're reading their Christmas cards. You ask about their kids. And now I'm telling you, this person has been systematically extracting wealth from you for years. That feels like a betrayal. It feels personal. And you want to defend them because admitting you've been on the wrong side of this relationship for a decade is painful. Let me be clear about something. Your advisor is probably a good person. They probably believe they're providing value. They probably sleep fine at night because they're following all the rules and genuinely think they're helping you. But that's exactly the problem. The system is designed so that good people with good intentions still extract massive fees from clients who can't afford it. Your advisor isn't malicious. They're just operating in a system where doing right by you means giving up income they've come to depend on. Think about it from their perspective. They have a mortgage, kids in college, their own retirement to fund. They're making $150,000, $300,000 annually managing client portfolios. Now someone, maybe you, asks, could I just use index funds and do this myself? If they say yes, they lose you as a client. They lose $7,000, $10,000 in annual revenue. Multiply that across their client base, and they're out of business. So they can't give you honest advice even if they want to. The structure of their business model depends on you not realizing you don't need them. This is why I keep saying this isn't about bad people, it's about a bad system. Your advisor isn't lying to you out of malice. They're rationalizing because the truth would destroy their livelihood. They've convinced themselves that emotional support, quarterly calls, being available during panics, that these things justify $300,000 over a lifetime. They have to believe this, because if they don't, they'd have to change careers or dramatically cut their income. So when you confront your advisor with these questions, remember, you're not dealing with someone who'll suddenly see the light and cut their fees 80%. You're dealing with someone whose entire financial life depends on you continuing to believe you need them. That's why this conversation is hard. That's why most people never have it. Because confronting someone you like, someone who's been helpful, and telling them you're leaving, that takes courage. But it's your money, your retirement, your future, and courage that saves you $300,000 is courage well spent. Because fiduciary doesn't mean cheapest solution. It means suitable advice serving client interests. Since peace of mind and comprehensive service can be argued to serve client interests, the expensive option is legally defensible. This is the fourth lie. That fiduciary status means they're truly working in your best interest. When compensation structures still create massive conflicts, fiduciary rules don't eliminate. Here's what your 1% advisor will never admit. For most people, especially retirees with $300,000 to $1 million, low-cost index funds beat anything the advisor provides. Not sometimes better, almost always better. The data is overwhelming. Over 10 to 15-year periods, 85–90% of actively managed funds underperform their benchmark index. After fees, worse, probably 90–95%. After taxes, worse still. But index funds pay no commissions. They generate no revenue beyond tiny expense ratios, 0.03 to 10% annually. An advisor can't make a living putting clients in index funds and doing nothing else. So they create what I call activity theater: trading, rebalancing, sector rotation, tactical adjustments. None adds value. Most subtracts value after fees and taxes. But it creates the appearance of active management worth 1% annually. The numbers: 2 people, both age 60, both with $600,000. Person A uses 1% advisor, mix of actively managed funds. Frequent rebalancing, tactical adjustments. Advisor makes changes based on market outlook. Total annual costs, 1.5%, advisor fee, plus fund fees. After 20 years at 7% gross returns, $430,000 net. Person B, DIY with index funds. 3-fund portfolio, total market international bonds, rebalances once annually, never makes tactical adjustments. Total annual costs, $0.08%. After 20 years at 7% gross returns, $100,000 net, same starting point, same gross returns. Person B has $670,000 more at age 80 because they avoided fees. That's the cost of activity theater. Your advisor will never show you this comparison. They'll show how they beat the S&P 500 last quarter, ignoring 3 quarters they didn't. They'll emphasize value adds like planning, tax advice, estate planning. Valuable, but don't require 1% of assets annually. They'll make DIY investing seem risky, but they'll never show the straightforward math. Index funds plus discipline, better outcomes than advisor plus fees for most people most of the time. Your advisor might say, "We provide downside protection. We move to cash during downturns." Sounds great. Problem is, nobody can consistently time markets. Not professionals, not advisors, nobody. Every study shows market timing subtracts value. You miss the best days trying to avoid worse days, and best days often come right after worse days. That tactical adjustment, moving to safety after a 10% drop, often means missing the recovery rally. But it looks like they're doing something. It justifies the fee. That's the point. This is the 5th lie, that active management and advisor oversight justify the cost when passive index investing outperforms after fees for the vast majority of investors. Here's another way advisors cost you money: tax inefficiency. Most 1% advisors manage taxable accounts with minimal regard for tax consequences. They'll rebalance frequently, triggering short-term capital gains taxed at ordinary income rates, 32–37% federal plus state. They'll buy high dividend funds, throwing off taxable income annually. They'll put tax-inefficient investments in taxable accounts instead of tax-advantaged ones. Why? They're not incentivized to minimize taxes. They're incentivized to maximize assets under management and generate activity justifying fees. Tax efficiency requires planning, thinking, coordination. That's hard. Easier to trade without considering tax implications. Example, you're 63 with a $500,000 taxable account. Your advisor rebalances quarterly, generating $30,000 in realized gains annually. You're in 24% federal plus 5% state brackets. You pay $7,000 a year in taxes on activity that added little value. Over 15 years, $105,000 in unnecessary taxes. If that money stayed invested at 7%, it would have grown to $250,000. You gave $250,000 to the government because your advisor didn't prioritize tax efficiency. A tax-aware approach minimized turnover in taxable accounts, systematically tax loss harvest, place tax-inefficient assets in tax-advantaged accounts, use municipal bonds for high brackets, plan withdrawals strategically. Most advisors don't do this. It's complex, doesn't generate obvious value clients see, and might reduce assets under management if it means advising you to max out 401k contributions, money leaving their management. Here's another inefficiency. Your advisor puts you in actively managed funds with high turnover. These distribute capital gains annually. You get a 1099 showing taxable gains even if you didn't sell anything. You're paying taxes on the fund manager's trading. Index funds have minimal distributions because they have minimal turnover. Over 20 years in a taxable account, this difference can be 0.5 to 1% annually in tax drag. On $500,000, that's $2,500, $5,000 a year additional taxes. Over 20 years, $50,000, $100,000 given to government unnecessarily. Now, let me translate all of this into what it actually means for your specific situation, because I know some of you are thinking, this is all interesting, Charlie, but what does it mean for ME? Let's run your numbers. Pull up your last statement right now if you're watching this at home. I'll wait. Look at your account balance. Let's say it's $650,000. Now look at your advisor's fee, probably 1% to 1.5%. That's $6,500 to $9,150 this year alone. Now think about how old you are. Let's say 62. You probably have 25 more years to age 87. Do the math. $6,500, that's 25 years, $160 over $500 in fees alone. But remember, that money would have grown. At 7% for 25 years, that $162,500 in fees becomes $315,000 in lost wealth. Now add in the fund fees your advisor has you in, probably another 0.5% to 1% annually. That's another $3,250 to $6,500 per year. Over 25 years with compounding, another $150,000 to $250,000 lost. Add in tax inefficiency from unnecessary trading and poor asset location, conservatively, another 0.3% annually in tax drag. That's $2,000 per year, or about $75,000 over 25 years with compounding. Total cost of your current advisor relationship over your retirement, approximately $540,000 to $640,000 in wealth you'll never have. That's your current path. Now let me show you the alternative path. You fire your advisor this month. You open a Vanguard or Fidelity account. You put 60% in total stock market index fund, 30% in bond index fund, 10% in international index fund. Total cost, 0.08% annually, or about $520 per year. You hire a fee-only planner for $3,000 to review this allocation and create a withdrawal strategy. You check in with them every 3 years for $1,000. You hire a good CPA for $1,500 annually to optimize taxes. You hire an estate attorney once for $3,000 to draft documents. Your annual costs, $520, fund fees, plus $1,500, CPA, house, $2,000 per year. Over 25 years, $50,500 in total costs. Compare that to your current path, $540,000 to $640,000. The difference, you keep an extra $490,000 to $590,000 over your retirement by making this change. That's not theoretical. That's not best case scenario. That's what actually happens when you eliminate unnecessary fees and conflicts. So when you're deciding whether to have this difficult conversation with your advisor, remember what's actually at stake. $500,000, your ability to travel in your 70s, your ability to help grandkids with college, your ability to afford quality health care in your 80s, your legacy. Is avoiding an uncomfortable conversation worth $500,000 to you? Because that's the real choice you're making. Most people choose comfort over wealth. They keep the advisor, avoid the confrontation, and slowly bleed $500,000 over 25 years. You're not most people. You watched this far. Now make the decision that saves your retirement. This is the sixth lie, that your advisor manages your total financial picture holistically, when they really manage assets in isolation without proper regard to tax consequences that cost you six figures over retirement. Here are better, cheaper, more aligned alternatives your 1% advisor will never mention. Alternative number 1, fee-only planning, $150, $300 an hour. Hire a fee-only planner charging hourly or flat fees, no assets under management, no commissions. Pure advice. Pay $2,000, $5,000 for comprehensive planning, retirement projections, Social Security timing, tax strategies, estate basics. They tell you what to do. You implement with index funds. Check in annually for $500, $1,000. Lifetime cost, $30,000 to $50,000 over 30 years instead of $300,000 plus. Your 1% advisor won't mention this exists. They'd make $30,000, $50,000 total instead of $300,000 plus. Alternative number 2, robo-advisors, 0.15 to 0.25%. Automated platforms like Betterment, Wealthfront, Schwab Intelligent Portfolios, auto rebalancing, tax loss harvesting, allocation management for 0.15, 0.25% annually. All mechanical benefits of advisors for 75, 85% less. Over 25 years on $600,000, this saves $180,000, $200,000 versus 1% advisor. Your advisor won't tell you robo-advisors suit 90% of people with straightforward situations. Alternative number 3, DIY with education, nearly free. 3-fund portfolio, total stock market, bonds, international. Allocate based on age, risk tolerance. Rebalance annually. Don't panic sell. Maintain discipline. This outperforms most professional management after fees, costs 0.08% annually. Over 25 years on $600,000 saves $280,000, $350,000 versus 1% advisor. Your advisor won't tell you this is viable for educated, disciplined people willing to spend 10 hours learning basics and 2 hours annually maintaining. Alternative number 4, hybrid approach. Fee-only planning every 305 years for major decisions. DIY implementation with index funds. Pay for specific expertise when needed. CPA for taxes, estate attorney for documents. Fee-only planner for Social Security, RMD strategies. Lifetime cost. $20,000 to $40,000 instead of $300,000 plus. I've watched hundreds use these alternatives successfully. They keep more money, have more control, understand their finances better because they're engaged. Outcomes typically beat comparable people using traditional 1% advisors. But the financial services industry spent billions convincing you investing is too complex, too risky, too scary to do yourself. They need you afraid. They need you dependent. Because if you realized how simple it actually is, you wouldn't pay them $300,000 over your lifetime. Let me be fair. Specific situations where advisors provide genuine value, complex tax situations, business income, substantial stock options, multiple state properties, significant real estate, K-1 partnerships, a good CPA or tax-focused advisor can save multiples of their fee. But this requires actual tax expertise, not just portfolio management, behavioral coaching. If you genuinely panic sell during crashes without someone to talk you off the ledge, an advisor as behavioral coach might be worth it. But that's therapy, not investment management. $7,000 a year is expensive therapy. True wealth management, 5 million plows, sophisticated estate planning, complex trusts, coordinating multiple professionals, business succession, comprehensive wealth management might justify 0.5, 0.75% fees. You're paying for coordination across multiple domains. Genuine lack of time. If you make $250,000 plus and investing genuinely isn't worth your time versus what you earn professionally, outsourcing might make economic sense. But be honest, is it lack of time or avoiding learning? 10 hours education and 2 hours annual maintenance isn't much time. For everyone else, probably 85–90% of people watching, the value traditional advisors provide doesn't justify the cost. You're paying for basic services and emotional hand-holding at premium prices. If you work with an advisor, ask these questions this week. Their answers and how they react will tell you everything. What would it cost to replicate this portfolio with index funds on my own? Good advisors answer directly. Bad advisors deflect or make you feel stupid for asking. How much am I paying total? Your fee plus fund fees plus any other costs? Insist on comprehensive numbers. Over 1% means overpaying. Over 1.5% means being fleeced. What specific measurable value have you added beyond market returns I'd get in index funds? Watch them squirm. They'll talk about peace of mind, not measurable. Being there during difficult times, emotional support, comprehensive planning, paid for once but paying forever. Push for actual numbers. Do you receive compensation beyond my direct fee? Commissions, 12B1 fees, revenue sharing, anything? If yes, direct conflicts exist. If they hesitate, there are conflicts they're not transparent about. If I moved everything to Vanguard index funds tomorrow, what specifically would I lose? Reveals what they think their value is. If mostly about emotional support, you're paying $7,000 a year for therapy. Can you show my actual after-fee, after-tax returns versus appropriate benchmarks? Most can't or won't because comparison doesn't favor them. Now, let me prepare you for what's going to happen when you ask these questions, because most advisors have prepared responses. You need to know how to cut through the script. When you ask, what would it cost to replicate this with index funds on my own? They'll say, well, you could technically do that, but you'd lose the comprehensive planning, the behavioral coaching, the tax optimization, and the peace of mind of professional oversight. Most people who try DIY end up making expensive mistakes during downturns. Translation: you're too stupid and emotional to handle this yourself. Your response: show me the specific measurable value you've added in dollars that justifies paying $300,000 more over 25 years than index funds would cost. Watch them struggle. They can't quantify it because it doesn't exist for most clients. When you ask, what am I paying in total fees? They'll say, your advisory fee is 1%, and the funds have expense ratios between 0.5% and 0.8%. So all in, you're looking at about 1.6% annually. Translation: they're hoping you don't multiply 1.6% x 25 years x compound growth to see the real cost. Your response: so over the next 25 years, I'll pay approximately $450,000 in total fees on my current balance? Show me in writing how you'll provide more than $450,000 in added value compared to a simple index fund approach. They can't. The math doesn't work. This question forces them to defend the indefensible. When you ask, do you receive any compensation beyond my direct fee? They'll say, some of the funds we use have modest 12B1 fees that help offset administrative costs. And occasionally, if we recommend insurance products, there may be commissions involved, but Everything is disclosed in your paperwork. Translation: yes, I have massive conflicts of interest, but it's technically legal and buried in documents you never read. Your response: so you're being paid by fund companies and insurance companies in addition to what I pay you directly? How do I know those additional payments aren't influencing your recommendations? Watch them get defensive, because they can't prove their recommendations aren't influenced. The conflicts are baked in. Here's what you'll notice during this conversation. Your advisor will try to make you feel unsophisticated for asking. They'll use jargon. They'll emphasize relationship and trust over numbers. They'll make you feel like questioning fees is somehow gauche or inappropriate. That's the tell. If your advisor reacts to fee questions with defensiveness or condescension rather than transparency and specifics, you have your answer. A good advisor welcomes these questions because they can justify their value. Bad advisors deflect because they can't. So have the conversation this week, ask the questions, watch their reactions, and be prepared to make a change if the answers don't add up to $300,000, $500,000 in value, because that's what's at stake. Not hurt feelings, not awkward conversations. $500,000. Your 75-year-old self is watching you make this decision. Make them proud. These questions make advisors uncomfortable. Good. If they provide real value, they should articulate and prove it. If they get defensive or can't provide clear answers, you know what to do. You're 55, 60, 65, 68, somewhere in that range, with 10, 25 years of retirement ahead. You probably have an advisor. You're probably paying 1% plus in fees. You probably never questioned whether it's worth it because everyone has an advisor. Well, you should do this month. Step 1, calculate total costs. Add everything: advisory fees, fund fees, transaction costs. Multiply by 25 years. That's what you're on track to pay. For most people with $500,000, $800,000 paying 1.5% total, this number is $200,000, $300,000. If that shocks you, good. It should. Step 2, assess what you're getting. Make a brutally honest list of what your advisor actually does month to month. Be specific. For most, quarterly rebalancing, 15 minutes. Quarterly reports you don't read. Annual meeting, 1 hour. Occasional phone calls. Could you do this yourself? Could you get this cheaper elsewhere? Step 3, run alternative scenarios. Calculate your portfolio worth in 20 years at current fee structure versus 0.08% index funds. The difference is probably $200,000, $400,000. Is your advisor providing $200,000, $400,000 in value? Step 4, have the hard conversation. Renegotiate fees, switch to lower-cost alternative, or go DIY. This conversation is uncomfortable, but it's worth $300,000. Most people won't do any of this. They'll keep paying, keep assuming their advisor is worth it, keep losing $200,000, $400,000, because confronting truth is hard. But you're different. You watch this far. You want truth even when uncomfortable. So do the math, ask the questions, make the changes. Your 75-year-old self will thank you when they have an extra $300,000. The systemic problem that won't change. Here's the frustrating reality. This isn't changing. The financial services industry is built on these conflicts. They're legal, accepted, normalized. Regulators tried addressing this with fiduciary rules, disclosure requirements, fee transparency. But the industry fights back with lobbying, lawsuits, loopholes. The Department of Labor tried implementing a strong fiduciary rule. It got gutted. The SEC has weak standards easily circumvented. Why? Too much money at stake? The advisory industry generates hundreds of billions in fees annually. They're not giving that up. So they'll keep the system as is, conflicts of interest disguised as financial advice, with just enough disclosure to be legal, but not enough to be understood. This means you can't count on the system protecting you. You have to protect yourself. That means understanding how advisors get paid, what their incentives are, where their interests diverge from yours. People who build lasting wealth don't trust the system to serve their interests. They verify, they question, they do math themselves. They fire advisors who can't justify fees. People who get fleeced assume the system is fair, that fiduciary standards mean something, that their advisor is on their team. They pay $300,000 in fees and never realize what happened. You're at a decision point. You've spent decades building wealth. Now you need to make it last 25, 30 years. You have to decide, pay someone 1% annually to manage it or take control yourself. The industry wants you believing you need them, that investing is too complex, that you'll make mistakes, that you need professional guidance. Here's the truth. If you can follow a simple 3-fund allocation, rebalance annually, and not panic sell during crashes, you don't need a 1% advisor. You can do this yourself for 0.08% in fund fees, keep an extra $250,000, $400,000 over retirement, and probably get better results because you'll avoid conflicts and inefficiencies plaguing advisor-managed accounts. But if you genuinely can't handle emotional swings, if you'd panic sell at first 20% decline, if you'd chase performance and trade too much, then maybe an advisor is worth it as expensive behavioral therapy. Just don't fool yourself about what you're paying for. You're not paying for investment expertise or superior returns. You're paying for emotional support and mechanical services that keep you from destroying yourself. If that's worth $300,000 to you, fine. At least make the decision with eyes open. The biggest lie financial advisors tell isn't about returns or risk or strategy. It's the fundamental lie embedded in the relationship structure, that they work for you. They don't. They can't. Not while paid based on assets under management, not while earning commissions on products, not while their firm's interests compete with yours. Some advisors are better than others. Some genuinely try minimizing conflicts. Some provide real value. But the system itself creates conflicts no individual advisor can fully escape. This is why I say, trust but verify. If you use an advisor, understand how they're compensated, calculate total costs, measure actual value delivered, question everything. Be willing to fire them if math doesn't add up, because the math rarely adds up. Most people would be better off DIY with index funds or using low-cost alternatives like fee-only planners or robo-advisors. The data is clear. The math is simple. The only question is whether you have courage to act on it. Your retirement doesn't belong to people who can afford to pay 1% annually to feel sophisticated. It belongs to people who understand that minimizing costs maximizes wealth, who recognize simple beats complex, who know the biggest threat to retirement isn't market volatility. It's paying $300,000 in unnecessary fees over 25 years. That's how Wall Street actually works. Not how they say it works, how it actually works. Now, if you want more brutal honesty about building wealth and achieving financial independence, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth.